Hello everybody, this is Tom from Chesapeake Tax and Accounting. It is November 21st, 2020, and I mentioned the date because we are just receiving information from IRS on the PPP loans, which has been much anticipated and much needed information on how we're going to handle the year end. Up until getting this information the other day, we really didn't have any idea how we would handle the loan forgiveness if you have a situation where you get the loan in 2020 and it gets forgiven in 2021. How do you handle that on your tax return? How do you handle that on your financial statements? So I want to go through all that, and before I jump right into the end, I want to give you a little background and give you a little history so we can put this into context. So back when the coronavirus hit, Congress issued an act called the CARES Act, which basically gave employers money to keep people on the payroll. And that was the CARES Act. It was the PPP loans, which basically is done through SBA. And according to the terms of the SBA loan, if all provisions were met and all the funds were used according to the directive of the SBA, as you see here on the slide, it shows that that amount would be forgiven and that income would not be taxable. So if somebody borrowed $100,000, they didn't have to pay back the loan. The loan was forgiven, and that it was a great feature. The act went on to talk about the taxability of that loan, and so normally when you have debt forgiven, that debt forgiven is taxable income to the extent that the debt was forgiven. The act specifically said that this debt, when forgiven, is not taxable. So a couple months later, IRS comes out with a notice, and finding it here it is, Notice 2032, and in my opinion, they kind of undid what Congress intended. Congress, I believe's intent was that this would not be taxable. IRS said that's fine. The loan is not taxable, but the deductions that you take for that loan are not deductible. So if you are borrowing money for payroll, if you're borrowing money for rent, if you're borrowing money for utilities, and you use those funds and you use those dollars and that's all you use those dollars for, and you pay it and you use it in full, the loan gets forgiven. You submit your application, that loan would be forgiven. And what IRS is saying is those expenses incurred will not be deductible. IRS in this notice goes on to give three illustrations of why it's not deductible. The first one is they use code section 265, which talks about you can't take a deduction for expenses in the creation of tax-exempt income. And a good example of that would be before the 2017 Act, advisory fees used to be deductible. And as you know, they're no longer deductible. But if you had advisory fees of, say, $10,000 and $5,000 was tax-exempt income, $45,000 was taxable income, you had $50,000 of total that came from those advisories, only 90% of that $10,000, only the portion that was on the taxable amount would be deductible on your return. And that's code section 265. The other illustration IRS uses in the notice is if you can expect to be reimbursed, then it's not deductible. Again, a couple situations. You have a casualty at your house and you have homeowner's insurance. If you don't put a claim in, you could have put a claim in, that you can't claim a deduction for expenses that you incurred if it would have been reimbursable under your insurance if you claimed it. Another example would be a situation with just an employee with employee business expenses. The employer has an expense form. If they don't submit the expense form, the employer is not entitled to take those deductions. So IRS is using that position to basically support where they are with that. That came out June, July-ish, right around in that time frame. And the situation that I'm looking at doing year-end planning for clients is, okay, you get the loan in 2020, you submit your application November, December for the forgiveness. It gets forgiven 60 days later. It's now February. Was the loan forgiven in 2020 or was it forgiven in 2021? And IRS this week has come out with guidance on that. They published Revenue Ruling 2020-27, and basically they reiterated the non-deductibility of the expenses in this revenue ruling. They also gave two examples. They gave example number one, where you basically incur all your expenses in 2020 and submit the application in 2021, and then it gets forgiven in you submit your application, you get your funds in 2020, you submit the forgiveness application in 2020, and it gets forgiven in 2021. If you fully expect to get reimbursed and the loan forgiven, the IRS's position is, in that situation, you basically cannot claim those expenses on your 2020 tax return. The next scenario they talk about where you basically go through the end of the year, submit your application in 2021, and then in 2021 later get it forgiven. Even though you haven't done the submission, at the end of the year, you've satisfied the requirements of spending the money on all the right places. And what IRS is looking at is intent. If you intend to get fully reimbursed, then in that situation, you have to claim or not claim those expenses on your tax return for 2020. So that was the purpose of Revenue Ruling 2027. I use two different tax publications to keep up on this information. The one is up to 2020 24. So this is hot off the press. This just came out this week from IRS, which is great because it helps clients do year-end planning now, because now they know what year this is going to be taxable. So if they're looking at their income and they have, say, $200,000 of income without regard to the loan, and they've got $150,000 of a loan, they've got $350,000 of income. Now we can do some planning. So this was very important. The timing, it would have been nice if it came out 2 months earlier, but it is what it is. So this would be the treatment on your 2020 tax return. IRS then comes in with a revenue procedure, which was kind of dovetailed with the revenue ruling. And the revenue procedure basically gives you a safe harbor in the event you want to claim some of those expenses. So let's do a little illustration. Let's say you have $100,000 that you borrowed on the PPP loan. You end up spending, and you only spend $90,000 on qualified expenses. You know at the end of the year that you're going to have $10,000 of non-qualified expenses. IRS is basically saying, with the safe harbor provision, you can take a deduction of that $10,000 in your current tax return. If you are going to do that safe harbor, there are certain documentations. You got to attach a statement, and you basically provide a lot of information with that statement to support that position. And then there's another situation where, let's say that you submit your application for forgiveness in either 2020 or 2021, and part of it is denied by the lender, and the lender rejects your application and says, you submitted an application for $100,000, we're only going to allow $75,000, and rather than appealing it or fighting it, you acquiesce and you just say, fine, we'll take it, it's low interest, we're fine. You have two scenarios. If you've already filed your 2020 return, you can go back and amend your 2020 return, or there is a provision which allows you to take a deduction in the year that the claim for forgiveness was denied. And so you could take the deduction in 2021. You would have your choice there. So I wanted to go through those because now from a tax planning standpoint, I think we have some guidance what the IRS is doing. The only wrinkle I see is Congress, in its infinite wisdom, would come back and say, hey, that wasn't our intent, IRS. Our intent was that this was free money, that we were loaning you the money, you didn't have to pay it back, and the expenses for which it was incurred are deductible, and you get a double benefit because we want to keep people in business and we want to help them out. Congress, if that's really what they want to do, is going to have to come in and clarify that, because IRS basically has, according to the Journal of Accountancy, quote unquote, doubled down. So that would be the IRS position. And then the last thing that I wanted to talk about was, with this position that IRS is taking, you're saying, okay, well, it's really no different than if the income was taxable, correct? And in the aggregate, the answer is yes, but in the detail, the answer is no. And that is because there are certain calculations that various taxpayers have. So if you're a professional service organization, like an accounting firm, like a law firm, not like an engineering firm because they have a great lobby and they were excluded from this, but most firms that provide professional services are going to have a two-tier test. And the first test is going to be your percentage of income. And then there are phase-out provisions where in that phase-out provision, if you look at this worksheet, the next tier is looking at wages. And based upon your wages, the PPP, the qualified business deduction, that 20% deduction would kick in. And so to the extent that I get a $100,000 loan and 80% of that is for payroll, my payroll number for the purpose of my QBI has been reduced by $80,000. Have home builders that may be on a completed contract basis. Again, that's going to change their overhead calculations. So this is not necessarily just going to be dollar for dollar. It's all income. It could be worse than if it was all taxable in the first place. So I wanted to share that with you. The nice thing it does is it gives us some clarity for doing our year-end planning. So if you have questions on the year-end planning, on looking at where we are, some planning ideas as far as preserving cash flow, looking at next year's tax rates versus this year's tax rates, or if you need to need assets for the business, we can look at those decisions, and we now have better information to make those decisions. So I appreciate you taking the time to listen. Hope this was helpful, and I look forward to working with you during tax season that is not too far around the corner. Have a great day, and God bless.